What happens when you want to buy a house, but you don't have a few $100,000 sitting in your bank account? You get a mortgage. Just like pretty much everyone else who's ever bought a home, a mortgage is a loan that someone takes out to purchase a home. The home becomes the collateral for that loan, meaning the bank will take possession of the house if one fails to make timely payments. Finding a mortgage isn't hard. There are hundreds of banks and lenders in Canada willing to offer them. Where mortgages get complicated is when it comes time to choose which type. In this video, we're going to go over one of the most impactful decisions you'll have to make about your mortgage: a fixed rate or a variable rate. Before we break down mortgage types, there are a few terms that are helpful for fully appreciating the different mortgage options. The amortization period is the total amount of time you'll take to repay your mortgage. In Canada, this is often as long as 25 years. After the amortization period is over, assuming you've made all your payments, you won't owe anything. You'll be completely mortgage-free. Woo! The mortgage term refers to a shorter chunk of time within the amortization period. When you get a mortgage, you are only committing to a lender and mortgage type for a portion of the amortization period. For example, 5 years is a common mortgage term. You might have 4 or 5 mortgage terms during your amortization period. After each mortgage term ends, you renew your mortgage. That means you can choose a new type of mortgage with better interest rates, or even take your mortgage to a completely different lender. For the most part, we're talking about the mortgage term rather than the amortization period in this video. The payment terms of a mortgage tell you exactly how much you'll pay and when. Some payment terms allow a little flexibility, but generally, with a mortgage, you don't get to choose what you pay. Your lender does. Payments can be weekly, bi-weekly, or monthly. Interest is the amount of money the lender charges you for the loan. Interest rates are a percentage of the outstanding loan, the part you haven't paid back yet. Since mortgages are usually hundreds of thousands of dollars spread over decades, even a fraction of a percentage point on your interest makes a big difference in the long run. There are basically 2 types of interest when it comes to mortgages: fixed and variable. And that brings us to the main topic of this video. A fixed rate mortgage is almost self-explanatory. It means your interest is fixed throughout the mortgage term and won't change. If you choose a 5-year mortgage term at 2% interest, you know precisely how much you'll be paying over those 5 years. Your payments will all be the same, and the interest you're charged will be entirely predictable. That's in contrast to your other option, a variable rate mortgage. A variable rate mortgage means that your interest rate can and will change throughout the term. And if your interest rate changes, your regular payment amounts will vary with it. With a variable rate, you sacrifice predictability, but you gain the chance of paying less. Of course, the variable rate is a double-edged sword. You could also end up paying more. Variable rates are expressed as a prime percentage, plus or minus. The lender's prime rate is their market interest rate that they base all of their loans on. And it fluctuates constantly. The variable interest rate might be, for example, a prime minus 0.8%. That means you pay 0.8 percentage points less than their prime rate, whatever it is, for any given payment cycle. Now you know what variable and fixed rate mortgages are. Choosing between them is a whole other matter. With a fixed rate mortgage, you're choosing predictability. It's easier to budget when you know precisely what your mortgage payments are going to be, but you may end up paying more in interest. Studies have shown that variable rate mortgages are the cheaper option 70 to 80% of the time. If you're okay with fluctuating payments and a little risk, variable rate is often the way to go. There are a few other things to consider aside from just the cost, though. Fixed rate mortgages can be easier to qualify for. With a fixed rate, the lender doesn't have to worry about you being unable to pay when the interest rate spikes. Because it won't. Another thing, variable rate mortgages often have smaller penalties for paying off the mortgage early. Mortgage lenders earn their money from interest. So unlike your friendly neighborhood loan shark, mortgage lenders actually discourage people from paying off their debts early. Though, a mortgage lender is unlikely to break your legs for missing a payment. Most mortgage lenders actually charge penalties for paying mortgages early. If you think you might want to pay off your mortgage in the short term, you'll probably want a variable rate. To put it as simply as possible, fixed versus variable is the choice between stability and flexibility. Are you the type to prefer predictability, or do you like taking a little risk and keeping things interesting? Let us know in the comments. And remember, no matter which mortgage you choose, your lender will require you to keep an active home insurance policy throughout the entire payment period. And you should have home insurance after that too. To get an online quote for your home insurance from Square One in less than 5 minutes, visit squareone.ca or click the link on the screen. Thank you for watching, and I hope you found this helpful. Subscribe is the button right there. And to see more videos of me, aha. I'm so sorry. Bye! Are we done? Keep that in there.